Good afternoon. Thank you for joining us. I'm Lori Siegel, and I'll be moderating today's webinar, 5 Building Blocks for a Better Compensation Committee. Today, we'll be talking about some actionable ways to improve your committee's effectiveness in designing executive pay plans in a way that drives long-term value creation. I have found that even small refinements to the Compensation Committee's focus and how it conducts its annual responsibilities can have a big impact on results. Terry Nuth and Matt Mulberger are joining me from Pearl Meyer's Boston office, and together we're going to outline several opportunities that can help boost the results of your Compensation Committee's time and effort. First, I'd like to turn it over to Sienna Breen with NACD's education team to take us through a few brief housekeeping announcements, and then Terry will kick things off with our agenda.
Thank you, Lori. Before we begin, I will go over a few housekeeping items, and then I will turn it over to Terry to start the program. First, if you can hear us but you can't see the slides, you may need to enable Adobe Flash Player. You should see an icon in the center of your screen where the slides would normally appear. Just click on that icon to enable the Flash Player, and that should bring up the slides. Also, if your slides freeze at any point during the webcast, please refresh your browser and this should solve the problem. On the right-hand side of your console, you should see several boxes. At the top, you can submit a question to be answered by our speakers during the program, time permitting. Please note that if you submit a question, you will be opted in to receive future executive compensation thought leadership from Pearl Meyer. In the middle, you can tweet live with us using @NACD and @PearlMeyer. And at the bottom and at the link on your screen, you can download a copy of today's slide deck and access additional resources. You will automatically receive 1 NACD skill-specific credit for your participation in this live webinar of at least 30 minutes. Credit may be applied to NACD fellowship programs, and you can contact fellowships@nacdonline.org for more details. Just as a reminder, a recording of this webinar, a copy of the slide deck, and links to the provided additional resources will be available early next week at nacdonline.org/webinars and at pearlmeyer.com. Finally, we will have a few anonymous evaluation questions at the very end of the program, and we would really appreciate your feedback, so please stick around after the closing slides to answer those questions. And now I'm going to turn it over to Terry to start.
Great. Thanks very much, Sienna. And thank you to all the participants in today's webinar. We appreciate you taking time out of your day for this valuable topic. And also a special thank you to Lori for agreeing to present with us. And Lori's got just a wealth of experience both through chairing multiple compensation committees as well as serving as an HR executive. So really excited to have her as part of the panel and have her be able to give her perspective and input on some of these topics. I did want to take a couple minutes just to set the backdrop on the session. And so, Matt and I were asked to put together a topic for this webinar a couple months ago, and so we gave a lot of thought to it. We gave a lot of thought to what would be valuable to the members of NACD. And we knew that there had been a lot of focus over the past few months on technical aspects and technical topics around executive compensation. So we had the tax reform and the implications on executive pay and 162M, and we also have the CEO pay ratio and disclosures and fallout related to that topic. And so there'd been quite a bit of emphasis there. And so we thought, might be good to swing the pendulum back towards some of the more practical, strategic, less technical types of topics, and that's where we really began the thought process around the topic today. The other thing is this really comes it's a timely topic because for many calendar year companies, this is the point in time where you really reboot the cycle around executive pay. You have Q1 and early into Q2, you're doing compensation decisions and disclosures. Many companies have either recently had or are going to be having their annual shareholder meetings around this time. And so typically what happens after that is that you restart the cycle for executive pay and start to get back into some of the more strategic and philosophical aspects. So we thought this would be a good time to talk about some of those things. And really those serve as the building blocks for a better compensation Compensation Committee. So you can see on the agenda here the 5 topics that we've laid out. 1 is around process, 2 around reevaluating the philosophy of the company, particularly as it relates to compensation. 3 is incentive plans and the goal setting process around that. 4 is around wealth sensitivity, and so this is really accumulated wealth through compensation, either cash and or equity. And then last but not least is really developing a plan and strategy around the proxy advisory firms. So those are the 5 topics that we'll walk you through today. And if we move on to the first one, which is around process and developing a theme-based calendar. So this is really a foundational aspect, in my view, for a compensation committee's effectiveness. We know that a compensation committee has a charter, and that charter provides, basic inputs around what are the key areas of responsibility for the committee. But really, we need to go beyond that charter, and we need to lay out a calendar that covers all the relevant topics for the committee, and covers them in a theme-based way, and also an appropriate cadence around the work. So we really want to spread out the work across the year. And so, developing this notion of a theme-based calendar and spreading out the work really can enhance the discussion and the process in each meeting and make sure that you're hitting on all the right marks throughout the course of the year. So what we have on this page is what the cycle would look like. And so for many companies, you start at the foundation, which is the philosophy. And that's one of the key underpinnings for all the other work that you do throughout the course of the year. The first one is, around evolving the philosophy, and then also taking a look at the peer group, because that serves as the market frame of reference. Then we would move into strategy. That would be the theme around the second meeting, where we take a look at marketplace trends and perhaps some of the preliminary incentive design constructs for the next fiscal year. Give some thought to that. Then we start to really get into the planning phase. That's where we're doing specific benchmarking around pay levels, understanding bonus plan funding from the current fiscal year, taking a closer look at incentive plans for the next fiscal year, and also budgeting for equity awards. Then we get into decisions. This is typically a Q1 activity where you're thinking about adjustments to salaries, bonus awards, new equity awards, and then finalizing goals for the coming fiscal year. And then last but not least is really governance, which typically happens around the shareholder meeting. So here's a governance theme to the meeting, and it's really around the charter, board of director pay, reviewing what some of the proxy advisors have prepared in terms of remarks and vote recommendations, and then evaluating your consultants to the committee.
So Terry, I like how you structured this, and I think that when you really take the time for philosophy and strategy, decisions are so much easier. And one thing I have found is that for those strategy and philosophy dialogues, I budget a little more time for my committees. And, you don't want to be sometimes on you're on a strict timetable. You want to really be able to let the conversation go and explore different angles. And sometimes we've even done those in different locations. So we really kind of opened our minds up to thinking about what are we really trying to achieve. But I very much like the sequencing and the order of the structure you've set up here.
Yeah, it's interesting, Lori, because you see it actually happen 2 ways. You see, you see some companies that will have philosophy as largely a check-the-box type item, but then other companies will go into much more depth around it. And certainly we advocate the latter, and I think providing an appropriate amount of time to have a good dialogue about it is certainly best practice.
Yeah.
So I think that's actually a good segue, because the second topic is around compensation philosophy. So I'm going to turn it over to Matt.
Thanks, Terry. So with that said, I think the key here that we really want to emphasize is the importance of having a philosophy and really keeping it current. So one is to actually include this as an annual topic. There are some companies, as Terry mentioned, that sort of have a pre-stated methodology or philosophy, check the box, so to speak, but maybe don't give this topic the time that it warrants. And so having it as an annual agenda item will really tee off a robust discussion. And that discussion should be around whether or not the philosophy should be evolving given changes that are happening in the operating environment. So some of the things to think about would be shifting business priorities, the profile of your leadership team, but also the evolving role of the compensation committee, where the committee's not just overseeing the pay programs, but really figuring out how to attract, retain, and engage a leadership team to build and deliver shareholder value. I'm going to turn it over to Lori for our first poll question of the afternoon.
Great. Thanks much, Matt. So I'm going to, hopefully you can read along with me, but I will read you the poll choices, and we're going to ask you to select the one which best reflects how robust your committee's review of the executive comp philosophy is. So no judgment here. Try to give us your most accurate and honest response. The choices are: we have a detailed conversation annually. We quickly review and confirm our current document or policy. We include our policy document in our materials for reference, but do not discuss. And finally, the topic is not discussed or covered elsewhere in our materials. So we will give you a little time to vote, and then we will be enlightened by what we see in the results.
Yeah, while we're waiting for folks to select their choice, I will say it's a very interesting topic in that philosophies can have a couple of areas that are what I would characterize as ubiquitous. So things like the purpose of compensation and the objectives that underlie the program. That's in virtually every single compensation philosophy, as is the philosophy that a company pays for performance. But you can really get into other more nuanced things as well in your philosophy, like what is the role of compensation in attraction and retention? And so does it play a cornerstone role in that process? Is it more of an after fact, and really it's more the leadership and the mission of the organization that are the cornerstones? So you can really get into some interesting discussions there. There's also other things like, how do you think about performance distribution? How do you think about promotions and titling? The rigor of the goals, which we'll talk a little bit about. So I think that, the philosophy is really something that you can make what you want, and you can really make it very, very holistic.
Well, to me, it's very much akin to, mission and value statements where, you can do them once and done, or you can really have them be guiding and help you to make decisions through the year. We're looking at our results now and see that 40% say they actually have a detailed conversation annually. That's actually higher than I expected, but together for the top two answers, we've got pretty close to 80% that are at least having some sort of review of their document or policy, and a good 25% here that don't discuss it really at all. Yeah. So I think all three categories up to the top, really an action insight from today's meeting may be, and you could very well be, if you've just completed your shareholder meeting, now would be the time to really think about putting some time aside at your next meeting. Dust off whatever you have, if you have one, really spend some time and talk it through. Terry and Matt, would you add anything to that?
I think that's exactly right. That way I interpret it was you got about 60% of the group probably could take a little bit more time to review the philosophy in a little bit more detail. Yep.
One of the things that we want to think about is what are we considering to be a detailed conversation. And so as we think about what that discussion might entail, we've broken out some considerations into external market considerations as well as internal company considerations. The one that jumps out to me on the left is really the labor market dynamics. So we're in a time of really extraordinarily low unemployment. There's lots of attrition. The compensation committee really should have its finger on this pulse. And does anything need to change in terms of the philosophy given the external environment? On the right, I think you really need to craft a policy that's appropriate for your team and your culture, or the team and the culture that you're trying to build, because the compensation program really can be a critical piece of what you're trying to achieve. With that, I'm going to turn it back to Terry to discuss incentive plan goal rigor.
Okay, great. So this is the third topic on the list, and it's around how should a compensation committee think about goal setting and incentive plans. And we all know that incentive plans over time have gotten much more complex. And there are more pay elements that include performance hurdles or goals. And there's also the concept of multi-year measurement in many plans. And that adds a lot of complexity to the process. And so what are some of the things that compensation committees should be reviewing, looking at, and discussing in the goal-setting process? So we have a few bullets here on the slide. I think one of the fundamental ones is really having the right management team members participating in the discussion. The last thing you want to have happen is have the committee have questions that can't be answered real time. I think that deters from the overall conversation, and so I think it's critically important to have certainly the CEO and in many cases the CFO as part of the process in order to really understand what management's proposing around goals, not only the actual goals themselves, but the philosophy and strategy around setting those goals.
And, you know, I might also add, at one of my boards, we've really involved the audit committee. So, you know, we find that the chair in particular, who's been a real sounding board for me in making sure that from their perspective, the targets and the ranges that we're setting are reflecting the kind of degree of difficulty that we anticipate. And so clearly every board member should have a point of view of that, but the audit committee is just, you know, a little deeper into understanding the financial targets. And so they're also a great resource at this stage in the committee's process.
Yeah, that's great. So you can either have people, either the audit chair or audit members sit on comp, or you have them participate in those specific discussions. I think that's a great idea,
right.
Lori. Yeah. Yep, so then the second one's around creating a process or methodology for setting goals. So what are the key inputs that drive the goal determination? And should there be any principles associated with that? So just by way of example, I work with some companies that are growth-oriented companies, and they say our threshold really should be last year's results. We don't want to pay for a decline, call it on revenue. And so they've put in place some principles around setting goals. And that kind of ties to the third bullet, which is evaluating your goals through multiple lenses. So what are those key inputs and key ways that you can triangulate and arrive at a goal that's, you know, not only acceptable to management, but acceptable to shareholders. And then last but not least, as we always want to do, we want to think about the pay and performance connection, so calibrating the payout and performance scale appropriately, and we'll go into a little bit more detail around that.
And so, Matt and Terry, we did have a question that I think relates to this topic, which is, would you recommend a quarterly interim performance review? And so I presume that means, should the committee be seeing on a quarterly basis how the company is doing against the incentive plan target?
Yeah, that's certainly best practice. My experience is it usually starts in Q2, so I think it might be early on in Q1 to be evaluating where the company stacks up relative to the goals. But certainly in Q2, Q3, and Q4, you want to start having those conversations so that there's no surprises come the end of the fiscal year. I think most companies that follow best practice would be doing that. Okay, so some of the key inputs that we think about as it relates to setting incentive plan goals are really the three that you see on the page here. And you can peel the onion a bit on these as well, but they really are grounded in the operating budget or the strategic plan to the extent it's a multi-year goal. what analysts or investors are expecting from the company. Also, what's been communicated to the street to the extent that the company is providing projections. And then third would be historical rates of achievement. And there's a lot of great analytical tools out there that can help, particularly with that last item. And it gets at something that Lori mentioned earlier, which is the probabilities of achievement. And so you can actually look back and see, well, how often is it that a company has hit a certain growth rate on a certain measure? And not only that, how often is it that peer companies have done that? And when you aggregate all that information, you can actually ascribe some probabilities to achieving the goals that are being proposed by management. And that's just one example. There are quite a few really good analytical tools that can help the committee out in this regard.
I think, one criteria to think about is, you're always under pressure to be very transparent and disclose how you've set your goals and what they represent. And so, for example, I was involved in a discussion where somebody recommended a target that was a percentage of, or the bottom of a range for guidance. And I can't imagine how you could ever disclose a goal like that. So I think, making sure you can transparently disclose your thinking and setting the goals would probably be a factor you'd want to take into consideration.
That's right. And it's also critically important that the committee ask for this information, make sure that you're getting it in the process, because oftentimes those things, there can be gaps. And so making sure that management knows that they have to present, all these different points of reference, I think is helpful in the decision-making process. And your example actually lends itself well to the next page, which is around the curves of the incentive plan. And so this also gets at goal difficulty, right, and setting goals that have the correct desired motivating effect. So we just have three simple examples here. I'll walk the group through them. The one on the left is what I would characterize as more of a traditional curve. And so the y-axis is the percent of target that you would achieve for the various goals, and the x-axis is the percent of the target that would represent performance. If you take the far left point at the bottom, that would be threshold performance at 90% of the target would pay out 50% of the target bonus. And this is a very traditional curve. 90 to 110% is the performance range, and there's a 2x leverage above the target. Many companies have this. The second one is a little bit more nuanced, and I would say this is more of a low bar type incentive design, whereby there's a recognition that the target itself may have a slightly higher probability of achievement, i.e. slightly easier to achieve. But what you do there is you adjust the thresholds and the maximums to account for that. So you have a very steep curve leading up to the target, and then it decelerates over the target until you get to the maximum. So you recognize that you want to get people to the target in a fairly easy manner, but you're going to make it significantly harder to outperform on the stated goal. And then last but not least, on the third is more of a situation where there's some uncertainty, lack of visibility around the actual target for the year. And so you set what I'll call a hitch in there. And that hitch basically says, well, we know you're going to be plus or minus 2% of the goal that we have. We don't know exactly where you're going to come in, so we're going to create a flat line around that target and then have an incentive, a more typical incentive line below and above that. And you do see that in situations where there's that lack of visibility into the goal. So there's obviously infinite permutations here. These are just three examples and three different ways you could think about the goal setting process. You don't always have to default to the left-hand side, which is that more traditional curve, and you can do things that are more unique and custom to the company. So with that, we'll go on to the next slide, which I think is our second poll question.
Great. Well, now that we've got this down, I will once again read you the choices, and we will ask you to vote. The question is, what does your committee's incentive goal discussion and assessment involve? And here you can select more than one, should more than one apply. So the choices are budget, annual analyst or investor expectations, historical rates of achievement, performance payout slope calibration, value sharing between company and management, so that would I present be sort of a percent of some gain, and other. I don't know if people can write in other or not, but perhaps we can have you, if not, we can have you type in some notes if you do choose other. So while you're voting, Matt and Terry, is it a matter of what best fits your company, or is there a right or wrong here?
I think that you really should let the individual company circumstances dictate. But that said, that at a high level, you should have some basic understanding, especially relative to, as we mentioned, guidance or the budget. You can't really completely overlook those two items. If I had to rank stack, those are probably the two most important. But certainly individual circumstances are always critical to any decision-making process.
Yeah, and it's Terry. I would just add that some of this can be refined by public companies versus private companies. So I'd say in the public company environment, certainly analyst expectations and guidance are a very key data point. Private companies tend to default more towards value sharing, do quite a bit of work with private equity portfolio companies, and that's one of the key things that they'll look at is what's the value sharing between points, between management and the investor.
Well, it'd be interesting as the results come up. I'm hearing much more conversation about analyst and investor expectations. So it will be interesting to see how our data comes out. So interestingly, almost everybody, not surprisingly, is looking at budget. And I'm going to guess that the number two, those that selected historical rates of achievement are probably looking at that as they set their budget. So where, budgets are generally viewed as some sort of year-over-year improvement, I think those two tend to go together. So my guess is there's a lot of overlap between those. I'm actually most surprised at we have almost 40% that are utilizing some sort of value sharing arrangement. Certainly nothing wrong with that. I just don't see that as often today. So, Matt and Terry, do any of these numbers surprise you?
I would say two things. One is I thought the other would actually, I thought we'd have a basket of others that might be higher. So that's the first one. And then the second one would be, I'm actually surprised that the value sharing isn't a little higher. The challenge you run into with it is that it's very hard to get competitive information on that, and particularly competitive information that's appropriate for your organization, because different business models can create very different value sharing results. But I do find that committees are interested in this at a minimum to understand it from an internal perspective.
The only thing I would...
Go ahead, please.
Sorry. Thanks, Lori. I was also going to add that we might be on the verge of shareholder advisory firms such as ISS putting a greater emphasis on trying to evaluate the rigor of goals. And so these items may become more important as we move forward. I think to date, ISS doesn't really have an effective way of gauging how difficult a goal is. And so the default has always been to just say we don't want to see goals that are lower than last year's actual payouts. And maybe that's what has really prompted committees to focus on historical rates of achievement, historical results, budget, et cetera. But I think moving forward, compensation committees are going to need to show that they are being more thoughtful and rigorous in terms of setting these goals.
So many questions coming in, because I think, first of all, I think this is the hardest thing that committees do. It's very, very difficult to get right. One question I'd love to sneak in here, another I think we'll come back to at the end, but, I used to work for somebody who would say a goal is obsolete the day after you set it. And what he meant is we're in a fast-changing world. Once you set these goals, if the world changes, do you have any opportunity to adjust, and what are the costs of doing so?
I would say that as a general matter, committees are they're going to try to avoid resetting goals. There's an optics issue associated for public companies, and there's also a kind of a consistency effect to things, right? So to the extent that you reset the goals one year, does it open it up that the plan is now able to be reset on an ongoing basis? So you really have to be careful about opening up that Pandora's box. That said, if you have an incentive plan that's not achieving its desired objectives, right? If 1 quarter into the year there's zero probability that there's going to be any payout under the plan, then you have to rethink that. And it may not be resetting the goals. It may be something else. It may be developing a second half incentive plan that motivates management to really stretch to get back to something that's more normal. And so there are different ways you could accomplish effectively resetting the goals.
And I think, just thinking back to an incentive plan theory, an effective bonus plan doesn't need to pay out at target every year. There are going to be some up years and there are going to be some down years. And certainly while there could be a situation that prompts us to want to take a more drastic action, I think that the committee often needs to be okay with the idea that in a given year, the goals may not be achieved and the payouts won't be what they may have been in the past or what the expectation may have been.
Very interesting. I know more questions related to this will come up, but why don't we move on to our next topic so that we can get through all of the wonderful slides you prepared.
So the next topic is wealth sensitivity. We spend a lot of time as consultants and compensation committees talking about target compensation or thinking about compensation as it's disclosed in the proxy. But ultimately, what's most important to the executive or the participant is the potential value of that compensation. So what could your committee be doing to understand this potential? One basic analysis shown here is to consider how stock price movement can impact wealth potential given current outstanding equity holdings. So we know that, for example, a portfolio with a heavier option mix will have greater leverage, but to actually plot that out and look at the dollar values can be really informative. I think the trick here is to sort of figure out what your approach to understanding those dollar values are. Here we have a y-axis for a CEO going from 8 million to 22 million. How does the comp committee know that 14 million is the right number or 20 million is the right number? That's a bit of a more difficult question to answer, but I think certainly understanding the individual that you're evaluating, understanding past performance, past realized values can all inform how you interpret this data. I would say that of the analyses that we're going to show you here, this is probably the one that we see committees most often understanding, certainly at the CEO level. I want to page forward to another perspective, also on the equity, but this perspective considers the retention value of these holdings. So we can also layer on in the green here what future awards may do to bolster the retention profile. So now we're not only understanding what those total values are on the y-axis, axis, but how retentive the profile may be over time based on vesting events.
And I would presume that ownership guidelines may suggest that you're trying to manage that to be no less than a certain number over time, aside from retention concerns.
That's right. The trick, though, is not all ownership guidelines are structured in a way that are really demanding of your CEO or your other executives. I think sometimes when they're first implemented, they're implemented really as low-hanging fruit, and oftentimes they're implemented at levels where the executives don't have to change their behavior. They maybe already are at a a certain level of ownership. But I think going forward, a committee could certainly be more prudent about setting ownership levels at multiples that do demand a change in behavior and would ensure that there is this wealth that's locked up over time and has a retention component.
Mm-hmm. Yeah. And another piece of this, just quickly, that I found is very helpful is understanding if there are any upcoming cliffs. So in this instance, you can see that this CEO's unvested equity value is going from roughly $10 million currently down to $6 million in a 1-year period of time. And so that's significant to the participant. And let's just say it was $10 million to $2 million. Well, that's really significant to the participant, and so the committee should be aware of that dynamic because they're now going from a position where they have this individual locked in equity value to a position where there may be some exposure. And so, the natural discussion should be, well, should we think about the future long-term incentives differently, the mix of equity, things like that, in an attempt to make sure that we've got appropriate retention hooks.
Yeah, I think that this graphic can really get at time horizons, and to the extent that there's a desire to lock up a high performer for a longer period of time, that this can be really impactful in terms of understanding that dynamic. Taking the wealth sensitivity analysis to the next level is a graphic that gets at total pay, considering the impact of both cash and equity opportunities. So we can use this 3D output not only to understand the wealth creation potential, but really to identify where there may be risks in the incentive program. So is there a level of company operating or stock price performance that provides greater incremental wealth? That might be an area for potential risk. So if it does exist, you want to make sure that the committee has the appropriate checks and balances in place to really ensure that only the right level of risk is being taken. With that, I'm going to turn it back to Lori for our next poll question.
Sure. So this question gets at how much does your compensation committee understand the potential wealth creation opportunity of the executive compensation arrangement? And your choices are, these are kind of easy, strong understanding, good understanding, fair understanding, or minimal understanding. And as you vote, I'm going to say once again, no judgment here. Many of these charts I'm seeing, although, of course we look at retention and we look at pay for performance, the sophistication of some of these charts are really new to me and really interesting. And I think it also helps you to think about the mix of your short and long-term incentives, with possibly the short-term emphasizing more financial outcomes and the long-term more focused on stock price performance. We see quite a spread here. Nice to see that 29% say they have a very strong understanding, but certainly suggesting there's a lot of opportunity for committees to apply more analytics to these questions of, I think there's a lot embedded here. It's wealth creation, it's pay for performance, it's retention, it's ownership. So a lot that this sort of analytical line of thinking presents. I think your comp consultant should be bringing you similar kinds of analysis to what we've just seen today from Matt and Terry. Any other Matt and Terry, any observations as you look at this?
Yeah, it's Terry. I just say I'm encouraged with the 30% of companies or of directors having a strong understanding of this. I think that's great. I think it's a really important part of the process for arriving at understanding the CEO's total compensation or total executive compensation, and using that as an input into the decision-making process. So that's great.
Excellent. Well, should we move on to our next topic?
Yeah, so this is Terry, and certainly this is the last of the 5, but not the least. and it's around developing a plan and strategy around the proxy advisory firms. So we all know that these firms have had increasing influence. I call it over the last 15 years or so. I think most of the folks on the phone will know what we're talking about here, but for those that don't, this is groups like ISS, Institutional Shareholder Services, and Glass Lewis. And basically what they do for public companies is they will provide vote recommendations on the items that are on the ballot for a company's annual shareholder meeting and proxy statement. And so it's of particular interest to compensation committees because many public companies have an annual non-binding say-on-pay vote. And so groups like ISS and Glass Lewis will evaluate a company's pay program and provide a recommendation to their subscribers around whether they should vote yes or against on say-on-pay. So they've become very important, and it's not only in the world of say-on-pay, also in the world of trying to get a new share authorization for an equity plan that would allow you to make future grants to employees and directors. And I'd say that you can see the spectrum of importance here, and I think that most companies would likely fall somewhere in the middle. I think that many companies like to say that they don't drive the decisions that a company makes around compensation, but they are certainly important and informative to that process. But I think what you would find is that there's a wide spectrum here. And some of the key things that companies should be thinking about when they're thinking about this overall kind of strategy or point of view on how important the proxy advisory firm should be to the organization are around what's the influence of those proxy advisory firms to your investor base. So the investor base would be the subscribers to these firms that would use these reports in their actual vote determinations. So what level of influence do they hold on your company? And also, what's the company's performance been like, not only just in terms of general stock price or financial performance, but also performance in terms of the general level of support on say-on-pay in the past. Because if you have a company that's a lagging performance company and has had real challenges with say-on-pay in the past, you might be more likely to have a point of view that these firms' vote recommendations are critical. And then last but not least is really just understanding the gaps between what your current programs are like and the different policies that these groups have and where those gaps exist and whether or not those gaps can be rationalized.
So it's interesting to me. I think this takes us in many ways back to the beginning of this webinar, because to the extent that your decisions as a committee are really rooted in your philosophy and your strategy, it might be easier to take a position, more defensible, I should say, to take a position that might not cater to what ISS and Glass Lewis have sort of spelled out as what their expectations are. And I think certainly it makes it easier to reach out to your shareholders and say, we've gone on a different course, but for a very good reason, and here's why. So again, this rooting everything you do, grounding everything you do in a firm understanding of philosophy and strategy, I think positions you to make a case and communicate more clearly to your shareholders, even when you're perhaps not in line with ISS Glass Lewis expectations. Our last polling question today is, what level of importance does your committee place on the results and commentary of the proxy advisory reports? And the choices are extremely important, important, fairly important, not important, or not applicable. So I'll ask Terry and Matt, how much does your shareholder outreach activity play into your strategy here?
So I think the outreach efforts are really a function of what level of importance you're putting on these outcomes. So for a company that knows that ISS, for instance, has a lot of sway within the shareholder base, there's going to be a lot of concern about what the ISS comments and vote recommendation is. And then I think you craft your outreach efforts both in the run-up to the actual vote and on the backside of the vote in follow-up conversations. There's going to be a lot of emphasis on some of those key topics that are raised. And it's really an opportunity in those discussions for the committee and management, to the extent it's applicable, to defend the decisions that have been made.
Yeah. It's Terry. I just add that I would really encourage committees to advocate to do these shareholder outreach efforts. I found them to be very positive and successful in areas where you have issues and you need to go talk to your shareholders directly, but also just on a normal course basis, even when performance is good and you want to have discussions with your shareholders. I found that companies that do it have had very good outcomes as a result of it.
Great. Well, here we have our polling results. So we see that most companies tend to fall in the middle. A good third say not applicable. I'm going to presume that's mostly private companies. But for the rest, a little over a quarter would say important or fairly important. 6.4% are very courageous, and they say it's not important at all. And 9.4%, those that say extremely important, it'd be really interesting to hear from our participants whether, that's because they have been in a bad position with regard to a vote or a negative, or, either not having a strong say-on-pay vote or failing say-on-pay vote. So any, Matt and Terry, any other comments or observations?
I would agree with all that, Lori, and I would just say, regardless of what the answer is now, it is it's an important topic and something that, just like your philosophy, can continue to evolve, and so it's good to have those proactive discussions around, whether or not you're on the right path in terms of their level of importance.
And I think your personal historical experience with the shareholder advisory recommendations can really sway the level of importance you put on it now.
Yeah.
It seems inevitable that at some point in time everybody's going to get a bad recommendation or a bad outcome just over the course of time. And so it'd be interesting to see sort of the before and after level of importance that companies are placing on these documents.
So we do have another question related to this topic. So if you are considering a change in your pay approach, have you with your clients have any experience of kind of prospectively reaching out to the proxy advisory firms and getting their support in advance, so it's not a sort of after the fact sell?
Yeah, I would say that that's uncommon to do. The reason being that there's two sides of the house to ISS, and they're not the side of the house that would meet with you is not going to be the side of the house that decides on your say-on-pay vote recommendation. And so they're not going to give you any guarantees around whether or not if you make that change it would result in a positive vote recommendation. Not to say that companies don't have discussions with ISS just to kind of feel them out, but I wouldn't go into it thinking that you'd get any sort of guarantees from them.
And you probably get more bang from your buck in terms of the time having that conversation prospectively with an actual shareholder than you would ISS.
Yeah.
And it looks like your next slide will speak to this as well. So I'll let you take us through that.
Yeah, so these are some of the practical tips, and Matt, if you could maybe just click on all of them. Some of the practical tips around how to think about proxy advisory firms and throughout the course of the year. So the column on the left is before they issue their report. Right, so what's some of the planning that can be done during that period of time? So one is to make sure that the committee's up to speed on their proxy voting guidelines and any associated changes. They do make changes to these voting guidelines, typically on an annual basis, and so understand what those changes are. The second is around running any simulations. Both of these firms have quantitative tests that they use to evaluate pay and performance, and ultimately those evaluations are part of the overall vote recommendation rationale. So, you can run simulations to understand if you're going to have any concerns. And then third is looking at your compensation discussion and analysis through that shareholder advisory lens and what their voting policies are, making sure you're heading anything off at the pass that you think could be problematic. So that's before. And then on the right-hand side, we have after. So after would be just having a debrief and understanding of what the proxy advisory firms said about your compensation program. What things did they applaud? What things were they critical of? And should there be any attempt to make modifications to the things that they were critical of? And then prioritizing those things if there are any. And then that lends itself well to the next bullet, which is around shareholder outreach, so making sure you have a sense of what those comments were, and that can be helpful in terms of anticipating questions and possible talking points when you're reaching out directly to shareholders. And then kind of what we covered earlier was this notion of off-season calls with proxy advisory firms. I think generally speaking, the companies that are doing this have some critical issues that they need to discuss with ISS and have had problems in the past, but certainly should be an item for discussion in terms of crafting your overall strategy in terms of dealing with the firms.
Well, Matt and Terry, thank you so much. Why don't you wrap it up with your takeaways, and then we have a few minutes for questions.
Yeah, I won't read the bullets, but I think at the end of the day, we want to make sure that the process is a very strong one, and that includes taking a fresh look at the calendar. And then we hit on a couple of particular topics we think, where if a committee has particular focus, I think that's really great in terms of overall improving the efficiency and effectiveness of the committee. And then obviously, goes without saying, being planful about everything is important, and not only with the proxy advisory firms, but on all matters. And so those are some key ways that committees, I think, like I said, can improve their overall effectiveness throughout the course of the year.
That's really terrific. I want to come back to a question in the goal-setting theme. And somebody asked about, and I'm paraphrasing, but it's basically, setting your thresholds and how far away from target is it acceptable to begin to pay? I think the question was specifically around 70% of target. Would that be an appropriate place to set a threshold? When might it or might it not be appropriate?
So I think it depends on the metric, and I think it depends on really the perceived difficulty in the eyes of the committee. And obviously some of that is going to be informed by what management is telling the committee. 70% on the surface, I mean, it feels a little bit low, but I could certainly be persuaded into, understanding that in a given situation, it might be a reasonable threshold. We'll see the thresholds and the maximums stretch a bit as we focus on metrics that are lower down the income statement. On revenue that has a lot higher degree of predictability, we wouldn't see a 70% threshold. I don't think we would support a 70% threshold, but certainly in an instance where there's a lot of uncertainty on the bottom line, there could be a situation where it would be appropriate.
Yeah, and I would just add that you have to consider it in the context of balance. So if the threshold is set at 70% of the target, is the maximum then 130% of the target, and are you effectively balancing things out? You're getting people on the incentive slope earlier, but you're making it much more difficult to achieve the maximum. I would be concerned if I saw a program that had a 70% threshold and a maximum that was set at 105 or 110% of the target.
And then also to tie this back to the performance payout scale, if the minimum payout is 50%, that might not really jive with a 70% performance threshold. If you earn just 1% of your target bonus, that might feel better in the mind of the committee.
Great. We had another question earlier about pay mix, and I think you alluded to this briefly when you talked about, with the goal of retention, you may consider shifting more towards longer-term plans. But are you seeing any trends in terms of where companies are going on pay mix?
Yeah, I would certainly say that there's been more focus on long-term incentives. If you look at the growth in the different elements of pay over time, the largest percent increase each year is in the long-term incentives. Now, if we had a market correction, that may go the other way because there's oftentimes a float with long-term incentive values to that of the market. But we've been on a pretty good run here for a number of years, and so we've seen that long-term incentive values have gone up and have taken a more dominant position in the overall mix of pay. And I'd say further, you're seeing that those long-term incentives that are making up a greater portion of the pie, a greater percent of those long-term incentives is allocated to performance-based equity incentives. So not just vesting on the passage of time, but vesting on the passage of meeting certain performance criteria.
Well, thank you. We said at the beginning that our goal was to give you some actionable insights and small ways that you can improve the effectiveness of your committees. I hope we've delivered on that. I've enjoyed the session, and I will turn it back to Sienna for a few more housekeeping comments.